Are you contemplating property investment in 2026? Prepare to uncover every vital detail you need to know about acquiring a buy-to-let property, including a crucial revelation about leveraging debt. Let's start with a fundamental question. What exactly is a buy-to-let? At its core, it's a rental property. You purchase a property, enhance it, and then rent it out to an individual. While the concept seems straightforward, there are several important nuances we'll delve into. First, let's consider why property, and then specifically why buy-to-let. If you have, for instance, £100,000 to invest, why choose property over stocks? There are a few compelling reasons. Firstly, property is tangible. Bricks and mortar you can see, smell, and touch. In the UK property market, there's nearly 1,000 years of historical data showing values doubling approximately every 10 to 15 years. Compare this to an investment in, say, the FTSE 100 index, representing the top 100 UK companies, and you might not find similar returns. While £100,000 invested in either might yield somewhat comparable results over time, the tangibility of property stands out. A sudden news article or a social media post from a prominent figure like Elon Musk cannot instantly decimate its market value. Furthermore, there's a humanitarian aspect I appreciate. You're transforming a house into a home for someone. To summarize the advantage of property over stocks, consider this scenario. You approach your bank, for example, Barclays, with £100,000 in cash and request an additional £300,000 to invest a total of £400,000. The bank, keen to lend, asks about your intended use for the £400,000. If you state you plan to buy £400,000 worth of Barclays shares, how do you think they would react? Not positively. They would likely dismiss the idea. However, if you go to the same bank and say, I have £100,000 and would like £300,000 from you to invest it in property, their response is typically, perfect. For buy-to-let, we offer 75% loan-to-value. Here's the money. Now think logically. Do banks possess significant financial expertise? Absolutely. Not only do they invest in property, but you, too, are already indirectly a property investor. When you deposit £100,000 in a bank, what do they do with it to generate revenue? They primarily lend it out for property. So, while you might already be a property investor, holding your cash in a bank means you bear 100% of the risk exposure with virtually none of the returns. Why specifically opt for buy-to-let as opposed to lease options, serviced accommodation, or commercial investment? Because buy-to-let represents the longest-standing, most stable investment opportunity within property, offering the lowest risk and highest comparable returns. If you seek a straightforward, stable, and hands-off investment, then a conventional buy-to-let is arguably the best approach. Having decided on buy-to-let, let's examine the key financial figures you must understand. The first and most apparent is the purchase price. This is somewhat negotiable depending on the seller's situation and motivation, but generally, it's determined by market evidence in the area, largely driven by supply and demand. Next, we consider rental income, specifically ensuring adequate rental coverage. Let's walk through an example. For a £100,000 property purchase, you'd likely secure a 75% loan-to-value mortgage, meaning £75,000 comes from the bank. Typically, buy-to-let mortgages are interest-only, so each month you're solely paying the accrued interest. Assuming an average interest rate of 5%, this amounts to £3,750 per year on the £75,000 loan. This annual cost is paid monthly. You then need to meet a rental coverage ratio, usually around 125%. To calculate this, you multiply the annual interest cost of £3,750 £4,750 by 125, which gives you £4,687.50. This means your property's annual rental income must be at least £4,687.50. Dividing this by 12 months, the property needs to rent for approximately £390, 63 per month. Rental coverage is a critically important metric, often explaining why investing in certain southern regions of the UK has become less viable for many. Next, let's discuss yield. People often refer to both gross and net yield. Personally, I focus solely on gross yield, and here's why. Gross yield is calculated as the annual rent, monthly rent, multiplied by 12, divided by the purchase price. For example, if a property rents for £700 per month, that's £8,400 annually. If this is a £100,000 property, your gross yield is 8%, £8,400 divided by £100,000, while 4% is a very high yield. It's crucial to understand that yield represents a balance and is an excellent indicator of risk versus reward. Generally, the further south you go in the UK, the lower the yield, as purchase prices are significantly higher relative to rents. Conversely, in northern regions, such as a mining village in the northeast, you might encounter conventional buy-to-let properties offering yields as high as 14%. While this might sound appealing on paper, it often doesn't translate well in reality. A very high yield typically signals higher risk. There's usually a reason property prices are so low. An easy test is whether you can even secure a buy-to-let mortgage, as many lenders are reluctant to finance properties with exceptionally low values. So, what's the ideal yield? It varies by area, but in our target regions, we aim for a gross yield between 6%, 5%, and 7%. Net yield, on the other hand, is gross yield minus expenses. However, this figure becomes problematic because expenses are so variable. Do you include voids, maintenance, management fees, insurance, or unexpected repairs? What about your personal tax situation, which differs from mine? It becomes an impractical figure, much like constantly factoring inflation into every investment analysis. While it makes logical sense in isolation to understand your real returns, in the context of deciding what to invest in, it's less useful. Most viewers are deciding times, what times to invest in, not times if times they should invest at all. Next, we delve into returns, a crucial aspect of property investment. While metrics like return on capital ROC, return on investment, ROI, and internal rate of return exist, I'll simplify by focusing on combined returns, which encompasses both return on capital employed and capital growth. Return on capital employed calculates how much cash you personally invested into the property, including all fees, and then measures your net return after all costs. For an easy example, if you invest £50,000 in total and achieve a £3,000 net return, that's a 6% ROC, £3,000 divided by £50,000. Now, for capital growth, the remarkable advantage is using other people's money. While you gain 100% of the property's appreciation in value, you haven't contributed 100% of the cash to achieve it. Let's say a £150,000 property, for which you put down a £50,000 total investment, including a 25% deposit of £37,500 plus fees, increases in value by 5%. That 5% on £150,000 equates to £7,500. So, combining your net rental income of £3,000 with a capital growth of £7,500 gives you a total of £10,500. Dividing this by your initial £50,000 investment reveals a combined return of just over 20%. Our target, for instance, is to achieve a combined return of 13% or higher. This illustrates why debt can be your greatest ally. You benefit from 100% of the capital growth, even though you only contributed a fraction, the deposit, of the total purchase price. In essence, you are generating wealth from other people's money, not just your own. Let's now discuss location, considering its impact on purchase price, property value, rents, and yields. Purchase price is broadly influenced by the country's region, but on a micro level, you can negotiate based on the seller's specific situation. I prefer not to be an opportunist exploiting someone's desperation. There's a clear distinction between a motivated seller, perhaps someone offloading part of a profitable portfolio, and a truly desperate one. Generally, excellent properties in prime locations rarely sell at a significant discount. Remember, price is what you pay, value is what you get. I've personally experienced the pitfalls of poor locations. My first 23 properties were acquired in mining villages in the Northeast with an average value of £50,000. The issue, they were worth £50,000 10 years prior, and even 12 years into my investment journey, they remain at £50,000. This stagnation is largely because properties at such a low price point often struggle to secure lending. Logically, while there's emotional attachment for those who live there, if you've saved £25,000 to £30,000 and are in a position to buy, you're unlikely to invest in such a static area. Instead, you'd probably look at beautiful areas where a 3-bedroom semi-detached property costs around £120,000, a stark contrast to the perception of property value in places like London. So, location is paramount, and price is what you pay, value is what you get. I ended up selling many of those initial properties at a loss, a crucial lesson in knowing when to cut your losses and not throw good money after bad. This leads us to focus on more promising areas. Yield serves as an excellent indicator. Anything between a 5% and 7%. 5% yield can help narrow down your search. This is just my opinion, but I generally avoid investing in buy-to-let properties south of the Birmingham line for long-term rentals. While I might acquire properties there for quick flips or development deals, I steer clear for rental purposes. My goal is maximum return on investment. I'm not interested in purchasing a £500,000 property if the rental income is comparatively poor, requiring a £300,000 personal investment. This is a business decision, not an emotional one. Therefore, I recommend areas like Nottingham and Liverpool. Manchester is less appealing for me, but Yorkshire stands out as my top choice right now. These regions consistently offer yields between 6% and 7% and 5%, fitting the desired criteria. Personally, I favor houses over flats, specifically 2 to 4 bedroom freehold houses, because I prefer owning the land outright rather than leasing it. My ideal tenant is a young working family, ideally a couple with 2 incomes, looking to establish a home and send their children to local schools. Consider factors like logistics, bus routes, and school proximity, and you'll be on the right track. Location absolutely matters. Why, then, are West and South Yorkshire and the wider Yorkshire and the Humber region so attractive for investment? It's due to significant ongoing investments, entrepreneur zones, and major projects like the South Bank development in Leeds. This is no minor undertaking. Located in the southern part of Leeds, the South Bank development spans an area equivalent to 300 football pitches, making it the second largest residential development ever in Europe. This isn't a quick project. It's a 20 to 30 year development cycle. representing a long-term investment in the expansion of Leeds city center itself. While you won't directly buy property within the development, the trickle-down effect is profound. Consider the improvements to bus routes, hospitals, logistics, cinemas, ice rinks, and schools that accompany such growth. Investing in nearby towns like Pontefract, Wakefield, Castleford, Huddersfield, Halifax, and certain areas of Bradford and beyond will likely see substantial value appreciation cycles. This entire region is experiencing significant uplift. Major companies, such as Channel 4, have relocated their headquarters from London to Leeds. Other significant employers, previously based in London and Milton Keynes, have also moved their head offices to Yorkshire. These strategic relocations are happening for a reason. You can explore the UK government's 30 to 5 zero-year development plans on their websites, which I believe will provide an exciting outlook. Now, let's address the legalities, navigating the legal process and its associated jargon. When dealing with legal matters, it's crucial to have everything correctly in place. This is another reason I favor freehold over leasehold properties. With a leasehold, you essentially lease the land, which often involves a management pack and adhering to the freeholder's rules, adding layers of complexity and increasing legal costs. It's highly probable you'll be purchasing property through a limited company, which I'll discuss further. This introduces additional legal considerations, as the company, not you personally, will own the property, though you'll likely need to provide a personal guarantee. While this can seem convoluted, the key is to engage a competent solicitor who understands property law. Critically, you shouldn't be doing any of this legal work yourself. It should be outsourced. Even with a portfolio valued at tens of millions of pounds that my business partners and I are looking to acquire, we delegate all the work to our dedicated team. The legal aspects are vital, so ensure your solicitors are regulated by the Solicitors Regulation Authority, confirming they are qualified to handle your legal work. Next, let's discuss ownership structures. Personal name, LLP, Limited Liability Partnership, or Limited Company, Ltd. To simplify, if you are a 40% taxpayer or aspire to earn at that level, which should be a goal for any ambitious investor, you likely do not want to purchase property in your personal name. While this isn't financial advice, and you should consult an accountant, a quick search for Section 24 should provide enough deterrent. In essence, mortgage interest, a substantial expense, is not a tax-deductible expense if you own property personally, which is quite illogical. So, for most of you, we can largely rule out personal ownership for now, though I acknowledge individual circumstances vary. This brings us to an LLP, a limited liability partnership. The key word here is partnership. An LLP requires more than one person to own property. If you're buying with a spouse, friend, or business partner, an LLP is an option. However, if you are investing solo, an LLP is not suitable. While LLPs offer certain tax benefits, these typically only apply if you are actively involved in the business, dedicating at least 20 hours a week. Again, consult your accountant, but this structure is relevant for only a small percentage of investors, leaving us with the common LTD or limited company. Why is this significant? Because it's not a minor detail. It represents a major shift in legal and tax implications. A limited company is its own distinct legal entity. Let's call our hypothetical company Dave for illustration. The reason I use a person's name is to emphasize that, Dave, the company is literally separate from you, Jamie. Many people say, I own all this property, but in reality, I own very little property directly. I own companies that own property. While it might seem like the same thing, legally and financially, it is not. This distinction is crucial. Do I want to be taxed as an individual? Absolutely not, especially within the UK's tax framework for individuals, which often feels unsupportive. I much prefer being taxed as a company. When a limited company owns property and conducts business, its activities are taxed within that entity, making interest tax deductible, along with many other business expenses. This is a complex topic for a separate discussion, but in short, consult an accountant, seek financial advice, and almost certainly establish a limited company for your property investments. Regarding finances and tax, I've touched upon the tax implications, but from a finance perspective, ensuring sufficient rental coverage is paramount. For buy-to-let bank lending, which typically involves interest-only repayments, let's assume a 5% interest rate on a £100,000 loan. This equates to an annual interest cost of £5,000. Most lenders require a rental coverage of 125%. This means you multiply your annual interest cost by 1.25. So, £5,000 multiplied by 1.25 equals £6,250. Your property's annual rental income must meet or exceed this figure to secure the desired level of lending. While you might still obtain some financing, you won't achieve the standard 75% loan-to-value typically associated with buy-to-let mortgages, which requires a 25% deposit, not 10%. If the rental coverage isn't met, lenders will reduce the amount they are willing to lend you. As you can see, there's a significant amount to consider, and we're not done yet. Moving on to surveys and due diligence. A significant advantage of purchasing with a mortgage is that the lender contributes 75% of the funds. These institutions are highly compliant and rigorously regulated. What I particularly appreciate is that if I'm unsure about the necessary analysis, the bank will often conduct much of it for me. They will scrutinize rental coverage, perform due diligence, ensure compliance, and crucially, arrange for the property to be surveyed. I highlight due diligence because if you're buying with cash, you must undertake more thorough checks. For cash purchasers, I strongly recommend obtaining a survey to ensure no critical issues are overlooked. While some investors choose to buy in cash, if you're buying with a mortgage, the lender will typically commission at least a basic survey, which, for a standard buy-to-let purchase, I find personally sufficient. You might assume all the hard work is done at this point, but that's far from the truth. You then enter a period of approximately 10 weeks for the legal and finance processes. For deeper dives into these specific aspects, you can subscribe to Property Counsel and hit the notification bell. Crucially, this is where your significant effort truly begins. After all the upfront work, negotiations, and compliance, you now need to manage the refurbishment and tenancy, which brings us to tenancy law. I won't detail the 156 pages of buy-to-let property regulations, but I strongly advise you to hire a reputable letting agent and absolutely avoid self-managing your property. Many landlords, particularly those with multiple properties, initially self-manage, only to discover later that they've been renting out properties illegally for years. This can lead to severe consequences, especially in tragic circumstances. If, for instance, a tenant suffers an electric shock or a fire in your property, the responsibility ultimately falls on you, the landlord. While such events are thankfully rare, they are serious. I've personally experienced tenant deaths due to old age and property fires, thankfully without direct fault. But the potential liability is immense if it were due to something I was responsible for. Therefore, I offer 4 essential pieces of advice. First, obtain an EICR, Electrical Installation Condition Report, every 5 years for rented properties. Second, acquire a CP12, your annual gas safety certificate, if your property has gas central heating. Third, ensure your EPC, Energy Performance Certificate rating is E or above, with future discussions about raising it to C. Finally, and critically, verify your tenant's right to rent in the UK. Failing to conduct these checks or not providing valid EICR, CP12, and EPC certificates upon move-in leaves you in a very vulnerable position if anything goes wrong, from a tenant ceasing rent payments to a tragic incident on the premises. Getting this right is non-negotiable. Why invest in buy-to-let property? Because the potential rewards are truly phenomenal. Let's explore the typical types of finance available for property investment. You can purchase with cash, which offers outright ownership. Alternatively, a mortgage utilizes bank funds as a long-term lending solution. Bridging finance is a short-term solution, typically up to 12 months, designed to bridge the gap between transactions, but it is considerably expensive. Finally, you can engage in joint ventures, where one party contributes capital or a hard money loan, and the other brings sweat equity through their effort and expertise. If you possess experience, have invested in your education, and are fully committed, you can attract partners to invest in you while you undertake the work. For now, let's focus on the three primary options: bridging, mortgage, and cash purchase. Some investors, for religious reasons, may prefer or require cash purchases due to restrictions on certain types of lending. For older individuals, or those with significant capital, for example, £500,000 at 80 years old, looking to buy properties for their children to inherit, buying cash can make perfect sense. However, I'm addressing the average investor, whom we'll call Pete. Pete is typically 35 to 50 years old, holds a stable job, and wants his money to work harder for him while he continues his career. While this is not financial advice, leveraging other people's money through mortgages is often the most strategic path. A mortgage typically offers a 75% loan-to-value for a standard buy-to-let purchase. It's financially astute to use this leverage because buy-to-let properties are tangible assets with inherently low risk, which is precisely why banks are willing to lend so much per unit. For me, a bank's willingness to lend is a strong positive indicator. So, while not financial advice, leverage is your friend, and using debt to accelerate your investment journey is a powerful move. In a previous video, I mentioned my portfolio exceeds £20 million. We are currently negotiating for an additional £30 million portfolio, or perhaps a £25 million portfolio plus another £5 million, along with some smaller acquisitions, which will bring my total portfolio value to between £50 million and £60 million. I do not possess £50 million to £60 million in cash. Even if I did, I'd likely be discussing a £200 million portfolio, as I wouldn't opt for cash purchases. It's a personal choice, but for 99% of people, I find it an illogical strategy. This brings me to bridging finance. If you are watching this video, my advice is do not use bridging finance. Why? Because self-awareness is a vital trait. If you've watched this far, your property investment knowledge is likely still developing, meaning you need to rely on experience, expertise, and a strong support team. Exploring bridging finance at this stage is not advisable. I use bridging finance myself. Currently, I hold approximately £6, $7 million in bridging debt, incurring around 1% interest per month, which means I pay over £2,000 daily in bridging interest. This is a significant sum to acknowledge aloud. However, it's justified because I manage tens of millions in circulation and have been a full-time investor for over a decade. 3 years ago, my total bridging debt was around £200,000, illustrating a long progression. Only use bridging if you are an expert or have an expert team supporting you. Otherwise, and Again, this is not financial advice. Purchasing with a mortgage is generally the way to go. Finally, let's discuss the type of property. I'll simplify this using our trademarked target criteria. Type of property, area, regeneration, growth, exit, and tenant type. First, the ideal property type is a 2 to 4 bedroom freehold house. I prefer freehold because it means owning the land outright, not leasing it from someone else. Why 2 to 4 bedrooms? This size appeals to a broad demographic in the UK, from first-time renters to those upsizing, downsizing, or families. My ideal tenant, my ideal customer, is a new family looking to settle down, ideally with children attending local schools. This is the demographic I aim to serve. Next is area. While this involves detailed statistics on crime rates, property tenure, schools, and logistics, which we analyze with a coded method for our investors. In essence, your tenant is your customer. You need to consider if times would want to live there, not if times would. This means assessing proximity to jobs and the availability of bus or train routes leading to employment centers. In the north, local buses and trains are utilized far more than in the south, based on my experience. So, thinking about the end user is key. R stands for regeneration. What investments are flowing into the area? This doesn't need to be directly within the property's immediate vicinity. For example, the South Bank development in Leeds, spanning 300 football pitches, significantly impacts West and South Yorkshire. Towns like Castleford, Pontefract, Wakefield, Halifax, Huddersfield, and parts of Bradford are all positively affected by this substantial investment. So, consider the broader logistical impact. G is for growth, specifically historic capital growth. While past performance doesn't guarantee future results, it's a strong indicator. I look for a minimum of 4% capital growth, ideally 5%. The last 5 years have been challenging for the country as a whole, but focus on the long-term trends for that property type. E for exit, or existing properties. Make it easy for yourself. Avoid buying off-plan property or new builds. These are almost always overinflated. Stick to resale stock, existing properties with established market evidence. Lastly, T for tenant type. While you technically cannot target specific types of tenants due to certain regulations, you can certainly aim for young, working tenants, ideally a couple with 2 incomes, who are contributing to the economy. My goal is to provide them with an excellent home. From the macroeconomic landscape to your personal financial growth, it all comes down to leveraging data and, most importantly, taking decisive action. If you began 2025 with aspirations of it being your year, yet found yourself paralyzed by inaction, then 2026 presents a fresh opportunity. However, success hinges on accurate data and informed decisions. I sincerely hope this video has provided immense value. If you haven't already, please subscribe to Property Counsel for more in-depth content. I hope you gained significant insight, and I look forward to seeing you in the next video.